Welcome to TheoTrade. This is Don Kaufman. August 5th, 2022. Moments to go to the cash close here on this Friday afternoon. Markets just all over the place today on what amounts to good news and trades gone bad. I'm going to describe exactly what that means here in this weekend update. First and foremost, let's get to work with a little bit of kind of a week in review. We'll save the jobs number for just a moment, but today trade is fast, trade is chopped out. We're just all over the place. I mean, the S&Ps, when the jobs number came out, set aside what you think about the jobs number. It comes out, look at the move. We're trading 41.60 all the way down and under to about 41.25. I don't care who you are. That candle has got to grab your attention as a trader simply because you recognize, and if you look at the S&Ps right now, it's all okay. We're going to finish massively unchanged, but there is aggressive amounts of volatility still packed inside of this marketplace. One of the things that's pretty astounding on this move, obviously this is pre-market, you have that kind of a move. When you start seeing, 30, 40, 50 handle moves in the S&Ps, the next thing I always do is I look at the volume. Here, what do we hit? 15,000 contracts. You realize, again, how destabilizing, that kind of a move is. And then the contract size is not exactly what I would construe as huge by huge. Again, just a very disconcerting aspect of today's jobs numbers. Now, let's come to the broader week. One of the things I like to do to kind of describe a little bit of, the week at large is to use expected move. So here we are on the SPX. And if you see the line that kind of bisects the screen right now, and what I'm referencing is this right here, you realize that is where last week ended. So for the most part, where are we on the week? You're about 12 to 13 SPX handles higher with just about a minute to go to the cash close. So for the most part, the SPX, I think you could make the argument that it is massively unchanged on the week. But there is a lot going on, which I'm going to describe here momentarily. There's heavy sector rotations, and that's really what's going to define some of the trade moving forward. So again, to kind of further this in the SPX, just get a look and a feel of what the S&Ps have done on the week. Again, the answer is a very large part, nothing. We had this $80 expected move. You're looking for an $80 move higher, $80 move lower. What do we get? Actual move to the end of the week, approximately $12 to $13. Again, pretty negligible. Nevertheless, we saw some big boy ranges though throughout the course of the week, and of course, the in one minute today, obviously we saw that jobs report, and it was over approximately a 35 handle move inside of 1 minute. So, and again, the big takeaway from that, with 25 seconds to trade, there is still volatility in dem dare market, and it is packed in. So let's actually go back a little bit here as we do come into the cash close. I'll tell you, in today's trading session, nothing to see here. Big sell side hit markets early on. As soon as markets opened, we ripped to the upside. We sold off again. We kind of meandered a little bit. Volume hasn't been half bad. There is the closing bell. Volume's not half bad. And I'm not looking here into the cash close, but volume throughout the course of the trading session, not half bad, which is, again, representative. There's decent size hedging activity coming through. All right, so let's start to break down a little bit of the week and some of the shocks that the market saw. So obviously the jobs number comes out. The good news, and good trades, immediately it flipped around on us. So think about this, if you will. It's what I was talking about on last weekend's update, and talked about it again on Wednesday night's video. It's the Goldilocks kind of scenario turned upside down. And what that basically means is we were in a situation years ago where bad news was being generated by the economy, or, we might get, for instance, a rough GDP print. And that bad news, constituted a move to the upside. Okay, invariably, like you're seeing the exact opposite. So why did we see back then moves to the upside and bad news? Because it basically meant, Fed policy, they're not going to do anything. Fed policy, keeping interest rates at zero, keeping the juice flowing. All of a sudden today, we get extremely good news, right? With that, maybe some good trades gone bad. And what happens on the good news is the exact opposite. Again, it's the upside down of Goldilocks here. 528,000 jobs. The market actually feels the shock, but nevertheless recovers. One of the things, though, that really comes to mind, and what everybody is, the talk of the town over here, happens to be this in the Fed Watch tool. And the Fed Watch tool is brought to you by the CME Group. And the reason I just wanted to bring up the Fed Watch tool briefly, as I said, it's kind of the talk of the town. Everything right now is about this is the current rate, and this could be the target rate. And what I mean by that is, we're 225, 250. There's about a 66.5% chance of a move to 300, 325. What that implies, there's a 66% probability of a 75 basis point hike being priced in right now. And I have to say, from my point of view, I'm rather surprised it's not higher. Enough said on that particular front. I mean, that's something that's going to just be beaten up for the next, 6-7 weeks till the next Fed announcement. I mean, the way I see it, why did the market tank? Market tanked because this is fuel for the Fed. The Fed's going to have to get aggressive out there. So the Fed, 75 basis points, here we come. Okay, but that is very much, I think, on the back burner right now. Like I could care less about the Fed, the next Fed move, 75 basis points. For all you know, really hot economic news could come out and they could be talking about a 1 basis point, like a full, or should I say 100 basis point hike, full 1%. I mean, things could get downright crazy in the next couple of weeks. There's just this huge gap between the current Fed announcement, which obviously just transpired. The next one is, it's again 7 weeks out. So with that, the S&P has become a little bit sloptastic. Now, here is an interesting place that I don't think a lot of people are necessarily looking at. There were some really wild sector rotations going on, and I have some fairly deep concerns in this particular front. So I tell everybody, even with this week's, price action, this week's price action, though, is pretty meager. If I come into the 30-day 1 hour, the entire week, and this is including even last Friday. So take a look at, for instance, this is last Friday's trade. This is where we were. This is where we currently are. What has happened? Absolutely nothing. I mean, the point that I'm trying to make with that is not absolutely nothing. Is, we're trapped like a rat in a cage. We're just oscillating back and forth. We're starting to accumulate more, open interest here. That's the makings of, again, a fairly phenomenal move that can transpire coming out of the levels that we're presently at. Push that aside for a second. Let me give you a couple of reasons to be a little bit concerned. So I noticed there were some wild sector rotations, really just big sector rotations. One of those happened to be into tech. So tech, on a year-to-date basis, I think I'll start here. On a year-to-date basis, tech is down about 20%. If you take a look at the S&Ps are down about 13%. Look at the XLF. The XLF's down about, we'll call it 15%. And of course, the energy sector happens to be up 27%. So what are the wild sector rotations? I think the way to look at this is if I bring up tech again, and I'm bringing the QQQ for tech, and I come in here and I do auto expected moves. Tech actually hit and breached the upper edge of its expected move, pulled back mildly, okay? And I do mean mildly in just today's trading session. I mean, where did the Qs finish? Down, but they did finish down just shy of about a 1% move to the downside, down about 0.8%. Okay, so the Qs actually came off a little bit, but net on the week, the Qs actually had a huge bid. Okay, I'm going to explain that in just a moment. Next in the docket, bring up the financials. Were you aware that the financials earlier this week touched the lower edge of the expected move, rebounded, and largely finished the week unchanged? Why is that so interesting? Like, what's actually driving this? Last but definitely not least, a less pivotal sector, but definitely still a market-moving event, happens to be the energy sector. The energy sector got decimated this week. It's a big bid back, okay? But for the most part, you're about 2 standard deviations out. So obviously that was oil. Oil, collapsed down a little bit. all the way back down to $88 a barrel. Let's push that one aside a little bit. So what's the cause for concern? Tech versus financials. Because in a larger sense, what you recognize is that bonds, well, today they got crushed. Bonds got crushed today, and tech started feeling the pain. The aspect, though, that I think really resonates with me is that bonds are in the driver's seat. And I have had just no feel lately for bonds. And I just want to bring that to your attention. I got no feel for bonds. I don't know anybody that does have a feel for bonds right now, other than to say we are in the midst of one of the largest yield curve inversions, I believe, in the history of markets. And that basically what I mean by the largest yield curve inversion. I think we're going to see the 2-year, okay, way over, for instance, the 10-year. It already is way over the 10-year. But if you're kind of curious about that and what actually transpired today, we can go take a quick glance at the 2 and the 10. And again, just come over to the trade. We're actually going to drop into futures. We'll come over to the small exchange. Look at the 2 versus the 10. I mean, the 2 is at 3.2. The 10 is now at 2.8. What do you got? You got a massive inversion. That inversion, though, is going to likely continue. So the interesting aspect is the moment that the bonds flinched to the downside, okay, what that entails is like the 10-year, obviously this is the 30-year, the interest rate associated with them is straight up. And as such, tech is actually going to feel the pain of that. The way that I always think of is tech are like degenerate borrowers. So if tech are degenerate borrowers, anytime there's a rise in like the 10-year or the 30-year, tech actually feels a little bit of pain. The interesting thing though is I just don't believe that tech felt the brunt of this hit right now. So bonds got crushed. Tech is not, in my opinion, necessarily feeling the pain. But the interesting part of the whole entire thing is that the financials reacted positively today to a rise in rates. And you go, yeah, financials should go up with rates going up. And I'll counter in for a second and say, well, yeah, but should financials go raging higher when there's a big inversion of the yield curve? And the answer is absolutely not. Okay, it's almost like the marketplace is discounting that signal of the 2 versus the 10. So I've seen a lot of media on this, a lot of media, because the Fed literally came out and said the 2-year versus the 10-year is not necessarily indicative of a recession. Although if you look back in terms of an indicator, this has actually been the single most effective indicator pretty much in the history of financial markets, that when the 2 was considerably above the 10 for any stretch period of time, that we were on the clock for a definitive recession. Nevertheless, okay, push aside what I might think, use your own to your own devices on that particular one. So bonds crush. And I don't think tech necessarily felt the pain, but here's the most interesting portion of all of it. When you started looking at tech in the most recent rally, start looking around at some of the big tech companies. Let's go back to year-to-date percentage, right? So if you looked at the QQQ has been tagged. It's still down about 20%. Microsoft, okay, only hit about a 25% loss and actually rebounded. It's down about 15%. Point I want to make, though, is Microsoft only played a role in the rally in the last 2 weeks. All right, Apple. Apple is unequivocally, okay, one of the marquee stocks right now involved in the rally. Okay, what rally? Well, specific to the Nasdaq and the S&Ps, though. Apple, though, is like the little engine that could to the upside, except it's not a little engine. All right, you have a $2.7 almost $1 trillion market cap over here. Looking around, Netflix. Netflix, in large part, okay, until the most recent earnings announcement. I do want to be very clear about this. You say, oh, Netflix, Amazon here. I'm looking at Netflix. Amazon here, for the most part, was down upwards of 35%. Now it's only down about 17%, but actually traveled in a very tight range. The range actually was broken to the upside, but literally that was just last week. So it's played a very meager role. Amazon has played a very meager role inside of the rally. Facebook, enough said on this front, hasn't played into the rally at all. Google hasn't played into the rally at all. Still trapped in a range. Tesla, here's your other main player. And it actually spun around today and saw some sell side. Okay, I'm going to make a very strong argument right now. Your entire rally inside of the Nasdaq and in large part in the S&Ps, a huge amount of it is actually fueled by nothing but Tesla and Apple. That's it. What else you got? I know you're going to point out Nvidia. Nvidia is just clawing back. It's still down almost 37% on a year-to-date basis. These are phenomenal moves, though, again, specifically inside of Apple, specifically inside of Tesla. If you want a reason that the marketplace is rallying, there it is. And again, I'm not just talking about tech. I'm talking about the entire S&P 500. Now, with it, sure, financials, though, really, the rally only kind of ensued maybe 2 to 3 weeks ago, and the rally is kind of meager in here as well. So what else you got? You got the energy sector. What's the energy sector done? And again, I absolutely include the energy sector in this. What has the energy sector done? Absolutely nothing. So again, I'll ask that question in terms of mega market cap. What do you got fueling this rally? Okay, and you got nothing but fumes. You just got nothing but fumes. You can start looking at some of the stocks that have just been beaten down and bludgeoned. I was making this point the other day where like Zillow, this thing hasn't come off the bottom. Okay, you look at there's tons of stocks that are just beaten down, bludgeoned. Peloton, Zoom. I could go all day long. None of these are actually recovering in any way, shape, or form. All we're seeing right now is a recovery. Again, I'll throw Microsoft in there as kind of a half shot because Microsoft, again, if you looked at the auto expected moves, broke outside auto expected move last week, but this week did absolutely nothing. But again, Microsoft did not play a role in the rally really until last week, till it broke to the upside. So we're on fumes right now. I don't like it, and it's one of the reasons I wanted to bring it to your attention. The bonds got crushed, and the tech sector should be feeling the pain. It's not feeling the pain yet. If you see more sell-side activity in these bonds, okay, mark my words, they're coming for tech. They're coming for you, and they're specifically going to come for Tesla in a very, very big way. Okay, I showed Apple, a trade that I did on Wednesday where it was an out-of-the-money put spread in there. Unusual trade for me. Okay, let's actually, change it up a little bit again. Can inflation be tamed with a dollar that's just absolutely raging? One point that I actually want to make before I start talking a little bit about the forward future here in the CPI is that the dollar reversed course today. This one actually even took me by surprise. It was the sheer magnitude of the move of the dollar ultimately on the jobs report. So we have a tendency to focus a little bit too much on the S&Ps or on the bonds, but I put a tremendous amount of weight into the dollar because this kind of a move in the dollar, it was a runaway freight train to the upside. So one of the things that I've mentioned often on these videos that has just huge implications to the forward of the market, and that's this. If you think about most commodities, doesn't matter whether it's oil, doesn't matter whether it's wheat, some of the metals, gold, and so forth, and silver, they're predominantly priced in US dollars. So as long as US dollar is strong, so you got phenomenal jobs number that comes out today, it makes the dollar rally. Now, the dollar rallying helps export inflation because, again, almost all of your commodities are actually priced in US dollars. So a stronger dollar not only beats down currencies like the euro and beats down currencies like the yen and beats down pretty much every currency around the world. So not only do you have a strong dollar beating up your currency, but then your commodity products are actually priced in US dollars with the dollar flying. That does not bode well for anybody. Can inflation really be tamed in Europe if the dollar is raging? And the answer to that, quite simply, is it's going to be a disaster to do so. Inflation at this point, okay, is going to run out of control. Maybe not necessarily in the US. The US, everybody's like, oh, maybe the inflation's peaked. We're exporting inflation at this point. We're doing it in significant style, especially with a strong dollar. So two things, again, now we have to watch for. Number one, as I said, mark my words, if these bonds continue to sell off, and again, you can mark any price point you want. The bonds start getting under 141. Just put it where they are. Those things come back down, it's over for tech. They're going to come for tech again in a big way. In addition to it, I was bearish in the dollar, and it still am bearish in the dollar. Nevertheless, if the dollar actually perpetuates a move to the upside, that's out of my control. I can be all the bearish I want, but it's out of my control whether the dollar perpetuates a move to the upside. If it does perpetuate a move to the upside, I think you have to expect that the S&Ps are going to get crushed and crushed in a big way. Obviously, your marquee stocks have got to be Apple. They've got to be Tesla. You throw Microsoft in there as kind of half baked, but again, those two stocks are directly responsible for the rally inside of the S&Ps and the Nasdaq. Last but definitely not least, over here we got to talk about the CPI and then the SPX expected move. CPI is going to define the marketplace. I mean, obviously the Fed has said time and again, CPI is not necessarily their preferred indicator. Maybe they like a little PCE, but in this next week of trade, mark my words, CPI is going to define us. Okay, you define me. The CPI number will be out on Wednesday, and that's it's consumer inflation. And I'll tell you right now, even if you think inflation's peaked, inflation's running, if it's running hot and really hot, like 9.1% kind of hot, forget about it. Like this marketplace is going to rage. So there's a lot of different estimates. And, the previous was 9.1, all right? And we'll just go off of that at this point in time. Let's not even try to handicap what that's going to be until we're a little bit closer to it. Nevertheless, if inflation's running hot, you have a hot jobs number, the Fed is going to come for you in a big, big way. And you're going to start hearing about a full 100 basis point hike to interest rates. So markets right now, though, I mean, I have to tell you, okay, boy, were they resilient today. Again, in the face of all this, in the face of adversity, the markets are incredibly resilient. Do I have an answer for that? No. I mean, listen, I still look at the S&Ps and think to myself, hey, we got to kind of like check a certain box right over here. Okay, that box is 4211. We didn't hit it. We're a rally right now, but we're only a rally from this 39.31 right into the 4211. People, we've seen this movie before. I mean, you don't have to look back too far to actually see a very similar move. Okay, right here. We moved from, 39.31, shot right to, and again, you want to zoom into that one. There it is. You missed it by a point. Shot right to the 42.11, pulled back viciously. And again, that was also on some hot data that hit the marketplace. You can actually pull up years of channeling though in this particular range. The point being over here is, you know what? Do I have bias right now? I think that there's some upside potential. And there presently is, right? So that 42.11, we may have to actually check that box before, again, news kind of hits us, halfway through the week. That CPI is going to be incredibly dangerous because the CPI could, if we actually write into the CPI, come in here to the 42.11, you realize CPI could just explode us higher, or we're just going to tank right back to the 39.31. Okay, I can't stand binary moves like this, but you take what the defense gives you. Last week, we were looking in the SPX at a $80 expected move. $80 expected move. And we lived and we survived. One of the interesting things this past week, we did not hit the upper nor lower edge of the expected move. If you look back some of the previous weeks, here's a week we hit the lower and upper edge. Here's a week we hit the lower edge, the upper edge. Almost every previous week, okay, almost every single recent week, this year, we've hit the upper or lower edge of the expected move. Okay, we've only had, here's a week where we did not do anything. We've only had really 2 other weeks this year where we didn't hit the upper or lower edge of the expected move. Why am I bringing that to your attention? Because I'm a bit of a probability kind of guy. And if you look out here to August 12th, which is the end of next week, all right, so we're pricing about an $87 expected move. Now that's just settling right now. So we're going to draw $87 expected move. That's a move $87 higher, $87 lower. I think you need to anticipate every ounce of it and then some. There's a lot to think about. Listen, this marketplace though it's flimsy. It is a rally. It is a very flimsy rally. Okay, it could actually substantiate itself if we can get to 42.11 before the CPI print. Okay, the CPI print comes out. Let's say it's a little weaker, we'll explode, to the upside off of that. It's the only way you're actually going to sustain this particular rally, because the rally right now is down to like maybe 2 or 3 individual products. CPI can change all that. CPI can actually cause the financials to get involved. CPI, again, can change everything. It's pivotal in this next week of trade. Again, a lot to think about in this weekend's update. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.